You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome to the first edition in 2020 of the Systematic Investor series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we continue our journey into the world of rules-based investing and where we do our best to give you practical advice based on our own experience so that hopefully you can avoid making some of the mistakes that we have made in our careers. Jerry, Moritz, good morning, good afternoon. How are things with you today?
Great, Niels. Thank you. Happy New Year and good morning, good afternoon.
Yeah, things are great here in Florida. It's early in the morning, so quiet. The bird is quiet, and so I'm looking forward to chatting it up with you guys.
Yeah, no, absolutely. And if you're tuning in for the first time, welcome. We love that you're here, and we'll do our very best to make the next hour or so as valuable as possible for you. Now, as a quick sort of recap, 2020 obviously only been really going for a couple of days, but it did start off with some increased geopolitical tension following the killing of the Iranian commander. But even if the stock bulls came under pressure for a little while, the S&P was only down slightly at the end of the week. So it does seem to be very difficult to spoil the ongoing bull market. But one thing I did notice, whenever we start a new year, it's quite common for economists to make their views clear to the market. But what is less clear when you look at their comments is finding any common ground between these. So I found these two examples. So we have Goldman Sachs coming out saying, overall, underlying great moderation appear intact. And we see the economy as structurally less recession prone today. While new risks could emerge, none of the main sources of recent recessions, oil shocks, inflationary overheating, and financial imbalances seems to be concerning for now. And as a result, the prospects for a soft landing looks better than widely thought. So that was Goldman Sachs, a well-respected firm, of course. And then you have Bank of America's global research team that came out saying that we enter this next decade with interest rates at 5,000-year lows, the largest asset bubble in history, a planet that is heating up, and a deflationary profile of debt, disruption, and demographics. So, pretty difficult to figure out which way to lean when you're listening to some of these market experts. But of course, it doesn't really impact the way we trade. So why don't we talk a little bit about what stood out in the week? Anything in particular, some of the markets that you follow that I may not follow, that had some interesting moves before we dive into how it all impacted our portfolios. I mean, what I noticed was just, metals doing pretty well, energy also doing okay. And to the downside, we had markets like nat gas taking a bit of a hit this week. But what about some of the more special markets, Moritz, that you look at? Anything exciting? What about Bitcoin? We need to start 2020 with some Bitcoin news, don't we?
Oh yeah, Bitcoin. So Bitcoin is one of those markets that I'm really, I guess I should be looking less at Bitcoin, but it's so nicely volatile and it's moving so much and it's trading 24 hours and 7 days a week. So you have to have a look at the thing. And so I currently have no futures position in Bitcoin. I think I've mentioned that I'm long physical Bitcoin, but this is kind of like since years and years when I first started buying a couple of coins and kind of like taking a bet on the thing. So I'm watching it. We had a bit of a dive about a bit more than a day ago below the 7,000 mark, where Bitcoin has been trading a couple of times in the last month. And it kind of like looked always to move to the downside, but it recovered really quickly this time. And we're now at 7,300. And, if we make a little bit more of a way to the upside, then I may be getting long again as well on the future side. So let's see. It is an interesting market. People follow it. There is now a lot of talk on Twitter, for instance, and probably at other places on the web as well about the upcoming halving of the block size and the block reward, which is expected to occur between April and May of this year, and there's all sorts of models which, as a result of that halving, forecast a substantially higher price because, as you know, Bitcoin is deflationary by design. There's only going to be 21 million coins ever available. There's not going to be any more. And now the supply going forward will be less and less and less. The mining reward will be less. So let's see how that pans out. It's interesting. Yeah. I think I spoke too much about Bitcoin, but it's an interesting beast. All the other markets, I must say, this week, it has been still a relatively quiet week, given that we've broken into the new year, with the exception, of course, yesterday. But I guess we'll get into that in a bit more detail in a few minutes.
Yeah, before we jump into that, I just want to hear from you, Jerry, whether there was anything on the sort of single stock side where you definitely differ in terms of portfolio construction that caught your eye this week? Anything exciting?
Well, I think, Tesla keeps going up. That's kind of fun to watch. Tesla reminds me a little bit of Bitcoin. A lot of strong opinions on both sides of what's real and not real. But I thought it was interesting that looking across the screens yesterday, it was not all the stocks were lower. It was a bad open, 400 lower in the futures, but kind of stabilized, and I think the panic was there, but not in its extreme forms we've seen. But I think the big news is still commodity longs. The old longs are coming back. They're still near the highs. The new longs are approaching the wheat, the soybeans, copper. It's sort of a long. The precious metals have totally recovered. So 2020 long commodity trades, this is kind of my dream bucket. Let's get some of these other markets moving to the upside and leave these shorts behind. So hopefully these things continue and we'll have 2 good years in a row.
Yeah, maybe before we move into our usual discussion, we talk about how the week kind of panned out. I mean, is there anything you guys feel that we need to touch on with respect to 2019? Obviously, when we last spoke, the year was not, over just yet. But I think it's fair to say that, 2019 will be remembered for a few things. One of the things for sure, it was a year where pretty much every single strategy you can imagine worked well. And the decade as a whole, of course, to many people will be remembered as a decade where central banks put their mark on the markets by very ample liquidity injections, even right to the very end of 2019. We saw massive increases in the balance sheet of the Fed. So lots of liquidity around and so on and so forth. And that's all well and good. But of course, it may also be a decade being remembered as the lost decade for CTAs and trend followers. Certainly some commentators will be quick to point that out. So I don't know whether over the kind of the Christmas holiday you've had any thoughts on some of these topics at all, or whether you have any final things you want to discuss when it comes to 2019 and maybe the decade as a whole.
Well, it hasn't been a lost decade for me personally, that's for sure. And as far as CTAs are concerned, I mean, 2019, my performance is pretty much in line with the performance of the SocGen CTA Trend Index. So, it's kind of like right there. But when we look at the dispersion of CTAs, which I find always an interesting thing to do at the end of the year, we've seen CTAs in 2019, trend following CTAs up more than 30-35%. And then there's a couple of ones which are down more than 25-30%, right? So it's the kind of like the usual spread. And then in the middle, we have on average, between 6 and 8% up. I guess what I want to say is that when we look at those indices, and if we use, for instance, the SocGen Trend Index to measure the performance of the industry, then as you know, those are CTAs which are relatively large, right? It doesn't include the smaller type of trend following firms. And we've mentioned that before, maybe the size and too much size is a hindrance. And when you looked at some of the CTAs, which are smaller, trading different markets, say alternative markets, I don't think they had a lost decade. I think some of them have been performing really well between 2010 and the end of 2019. So it's a matter of perspective, I think. If you just look at those, the B Top 50 or the average industry indices, then you need to be aware of the fact that there's a lot of very large firms in there.
Yeah, no, I agree. What about you, Jerry? Any thoughts on 19, the whole decade? Anything that springs to mind?
Well, definitely 19. I think pretty much 19 is all about the bonds. If you traded a lot of bonds, you made that 30%. If it was less bonds, for whatever reason, you made less, a lot less. So I think the bonds were the gift that keeps giving, and they had a nice day on yesterday, so they don't kind of weaker, but they're not giving in yet. It's probably still what I would consider to be okay to have some long positions in your long-term trend following system. So I think the bonds were pretty much the news of last year, and everything else probably was pretty much break even, but and that's the way it should be. We had some big moves there, and depending upon your portfolio philosophy, you could have had 20 bonds on, or you could have had 4. Then I think it's sort of interesting to look at the stocks as well, in that that is a real good idea, that a classic example of trend following and how trend following can kind of differ from buy and hold. So the buy and hold, the stocks made a lot of money because it just so happens that December 31 was near this spike down low that we got crushed in the fourth quarter last year. And so they get to measure the buy and hold from this low point. And so, but from a trend following point of view, we may not have gotten back into those stocks until, weeks or months later. Let's see here. So maybe I'm looking at the chart, March, April, May. So we gave back a lot of that rally as we sort of wait for that trend, those shorts to fail and the upside trend to continue. So we kind of delayed our entry. And so even if you trend followed the stocks, you didn't have that kind of move that buy and hold people have in stocks, or the type of move we had in the bonds. So it's kind of a fake performance in the stocks as it relates to trend following.
Yeah, no, I mean, I agree. I think definitely 2019 was very much shaped by how you handled the bonds to a large extent. I mean, from our point of view, 2019 kind of ended very close to our super long-term average. Pretty much the average from 1974 until now is in line with how the year 2019 ended. So by all means, that was perfectly fine. The decade as a whole also pretty decent. And more importantly, I would say it was a decade where our correlation to the S&P was 0.03. So exactly, I think, what people should expect from what we do, and that is a non-correlated return stream. We're not a hedge. We're not crisis alpha, in my opinion, but we are an uncorrelated return stream, and I think the last decade confirmed that on our side at least. So yeah. Let's leave 2019 for now, at least until we decide to go back to it. And here, Moritz, always interesting to hear how your week has been. I know there's a couple of days from 19 and a couple of days from 2020 packed into the week. But there was a bit of excitement, as I mentioned in the beginning, on geopolitical side. So how did it all show up on your side?
Yeah, so this week really only had, if you want, one day, which was yesterday. All the other days have been super quiet in terms of returns for my portfolio. There hasn't been a lot of movement because, people were or are still kind of like in New Year's mode, and there has been a public holiday the 1st of January, right? So not a lot of things happening. But so yesterday, it was really all about yesterday. Yesterday turned out to be a good day for my portfolio. It's always this double-edged sword. You look at the news, and it's never great to read and hear about those news. But I still had the long bond positions on, as I've mentioned last week, and the bonds have been rallying quite strongly yesterday, so that has made me the money. And the equity longs that I have on, they've lost a bit, but not as much as the bonds gained. So that's essentially been the trade. Long the energies, have that position on, not fully developed, but it's long. And so that helped as well. So I'm up 1.5%. And that's a good start into the January month.
Yeah, certainly is. Certainly is. If you can do that every week, Moritz, you'll be well rewarded.
No, that's not going to happen.
Oh, okay. Sorry, I misunderstood that. Yeah, so I mean, on our side, the last couple of days of 2019 actually did put a little bit of pressure on performance. I think that was clear for all CTAs, us included. So, but then, as you rightly say, the last couple of days have been fine, and so off to a good start in 2020. For the week, I would say, equities clearly detracting from performance. Some of the currencies, in particular the yen, didn't do well for us. And then on the upside, we had generally most of the fixed income markets helping out. But the standouts in terms of single markets really were things like natural gas, Brent, lean hogs did well. So nice to see that there was a good contribution from the commodity side of the portfolio, and also, as you said, I mean, kind of nice to see that there was performance to be had, despite equities being by far the largest exposure right now. But even in a week where it didn't really help, there were other things that stepped up and did what they needed to do. So yeah, so far so good. Jerry, single stocks, how did they impact, and how has your year started or week?
I like the start to the week. The stocks, like I said, a lot of them were up a little bit yesterday, so it wasn't across the board shellacking. Maybe if it was down 500, we'd have seen something like that. But, just down 200 points in the Dow is not too much. And a lot of good things happening in the precious metals, and the dollar, I think, started to have a decent day, but I guess that's still in the open column for me. What's going to happen with the dollar this year? I think everybody wants to sort of get short the dollar, but it seems to also to be hanging in there to start the year pretty well. So, but once again, I'm got different positions on short Europe and Asia, but long Turkey, Israel, India, South Africa. So it's just a lot of good diversification there.
Yeah, cool. A decent start in the markets. Of course, we're also interested to find out how the beginning of the year, which I think started out a little bit dramatic. Maybe you want to fill us in there on that one, Jerry. But Twitterland, we saw a few tweets, but we also saw some people leaving Twitter.
Yep, pretty shocked that one of my most favorite people on Twitter, Cliff Asness, closed his account. I'm hoping he's going to come back. He adds a lot. And, people criticize me on Twitter as well. I mean, just rude remarks and things. I think that they're rude remarks. Sometimes I can't really tell. But, and I have such a thin skin, I think that I'm just like, golly, this is just too much. But, you just need a break, and hopefully he'll take a break and come back. Because he's really funny and really insightful, and people love him. And when you're out there, you're just going to get criticized. So unless you remain anonymous and don't participate in life, you open yourself up for a little bit of criticism. It does sting, but I'm hoping he's going to come back. We'll miss him. Yeah.
I was just going to say, especially because he took the time to tune in and listen to our last discussion regarding one of the papers he put out. And so, I think we're going to miss him and his contribution, and hope that he'll be back. But so what else did take place in terms of interesting stories, content-wise, in your Twitter feed?
It's pretty quiet for me, but I did tweet something yesterday that probably ended up being 24 hours ago. That became my most popular tweet. It's an article. It's an interview of Richard Thaler on Barron's. He says, the biggest mistake people make in life is overconfidence. The rise of individual investing in the 90s was caused by the illusion of information. When the market was going up 30% a year, it was very easy to convince yourself that you're a good investor. So I thought that was pretty interesting. overconfidence. Yeah, I think that's overconfidence in your fundamental opinions, how the world's going to work, what this means for the future. As you were saying earlier, I get kind of sick and tired of listening to all of this stuff about market is overvalued and it's going to go lower and we're sowing the seeds for a big recession, or the opposite. I mean, they both. It's just back and forth. And one of the things that is just crazy is how one smart person will post something that says this shows that sentiment is through the roof, and then another smart person will post no, sentiment is really low, people are not very bullish now. I'm just like, what in the world? And in how many years and months and decades will they go calling the top in these markets and before they stop? I mean, there's like no shame. Maybe it's a little bit like the CTAs. How long will we go with this underperformance before we shut up about trend following? I mean, for me, never, right? So maybe it's the same with them. They'll just never be quiet about value and fundamentals. And I think one of the edges we have is that, we don't really, our confidence, we don't have sort of confidence in the markets or trade. We just put it on and it's probably going to lose. We're just going to ride the trend. So I think the overconfidence thing probably doesn't bite us as often as it does others. And I really like this phrase, the illusion of information. So we have this information. We're bombarded by information these days. There's so much information out there. And so the illusion of information, what does that mean? It means that we transfer more information into better decisions. Well, if that's what he means, that's obviously not occurring. So what do you think?
I enjoyed that article, I have to say. I thought it was really interesting. I mean, of course, it touches on something that we've talked about on many occasions. And I think this is one of the most important things that investors should pay attention to, and that's kind of the behavioral finance or behavioral economics and how to deal with biases in general, overconfidence being one of them for sure. And I just think it's a fascinating topic, and I think people are disadvantaged if they don't pay attention to it and try and find ways to deal with it. I love some of his comments. I can't remember sort of word for word, but I think at some point he talked about a story where he was invited on one of these TV shows, CNBC, Bloomberg, whatever it was, and where they were asking him about, so what are you going to do with your money when everything gets difficult and the markets are down a lot, et cetera, and I think he replied, well, the first thing I'm going to do is I'm going to turn off all TV channels, including your show. And then he said, well, he was never invited back. But it is true, and I'll bring up another point about information later on, which I think is just mind blowing, really. But no, I enjoyed the article in Barron's that you tweeted out. I think it was really, really great. And also he talked a little bit about algorithmic trading. And I think that one of the things he says is something like, what is true is that a model, if followed, is reliable and predictable. In many situations, replacing humans with algorithms makes sense. So, he talks our language, of course, and so we're fans straight away. But I do think it's super important. What about you, Moritz? Did you have time to see it as well?
I haven't read that particular article, but I like Richard Thaler. He's a behavioral economist, and I especially like when he and Eugene Fama are in the same room and they go in a very friendly way head to head about who's right on about how markets work. And Dick Thaler, of course, says there's a behavioral element and markets therefore are not efficient. And Eugene Fama says, well, even with that behavioral element, they're still very efficient, and it's kind of like this back and forth. So that's enjoyable. But what I wanted to, what crossed my mind is, with all the forecasts about, what the economy is going to bring in 2020 and whether that's going to be a soft landing or a recession or not a recession at all and just more growth. Niels, you've mentioned the Goldman Sachs and the Bank of America forecasts, which kind of like seem to be opposite of each other. And I'm like, Jerry, it's like, this is all cheap talk to me. Now, what I'm complaining about to myself is that I'm apparently unable to switch off my small monkey brain and stop reading that stuff. I should really, I mean, if there were a flag on Twitter or on the internet saying like, this is an article that speaks about the future development of markets and gives a forecast about the economy, then I'd love that to be kind of like flagged away and immediately deleted so I don't have to clog up my brain with that stuff. Because really, I mean, over all those years, the benefit of hindsight, in December 2020, when we look back at the Goldman forecast and the Bank of America forecast, I mean, probably neither of them is going to be correct. So it's an opinion. People have opinions and they manufacture their opinions because it's clickbait and they need to have an opinion in order to sell and get marketing ad dollars. I just wish that I was smarter and had the ability to just not read it.
And then at the very end, after all of this evidence, the illusion of information, I read the other day, but I'm not making a prediction. Yes, you are. I mean,
exactly.
You're hitting me over the head with these predictions, and I just don't get it. I just feel so superior just saying, okay, reality is price, and maybe the illusion of price exists sometimes where obviously we lose on most of our trades, but I'll go with the illusion of price and where the market's going and what the market is sort of saying internally and over the illusion of information.
Yeah, I mean, I think what you're saying, Moritz, makes obviously a lot of sense, but it also, I think, highlights the problem really at its core, and that is we're all humans, right? So even though we know what to do, it doesn't mean we're going to do it. And for most people, of course, that's going to be the overpowering bias. So they're not going to do at least what we try to do, and that is when it comes to making investment decisions, to completely ignore the noise and just focus on the price. At least we can do that, but we're not quite there when it comes to completely ignoring everything that goes around us and what people are saying. But at least it doesn't influence our decisions when it comes to managing the portfolio. So it's one step in the right direction, I guess.
Thaler goes on to say in this article, this got a lot of attention as well. My followers love things like this. No strategy can work all the time, or it would be arbitraged away. So it has to be the case that styles go in and out of favor, and it has to be the case that they do so unpredictably.
I mean, case in point, let's look at the CTA index, the trend index, SocGen trend index. I mean, it's only up 29% for the whole decade that we just came out. So by all stretch of the imagination, I would say that's certainly not a stellar return. But then let's not forget that the decade prior to that, the S&P total return was down 10% for the whole decade. So it's not like one, type of investment can't be, as you say, not working for a period of time. It certainly can. And there seems to be no clear predictions that you can make from one decade to another in terms of what the future performance is going to be of an asset or an investment strategy.
I was just thinking how often we get that question, and we ask ourselves, when do we know things have stopped working, a system or a whole strategy? And I like the part where he says, it must be the case. This must be the case that styles going in out of favor, and you can't predict it because of this arbitrage that would happen if it was not the case. So I feel a little more comfort in that strong opinion of his than maybe some of the answers I've given historically.
Good stuff. So what else caught people's attention this week, Jerry, besides Richard Thaler?
I like this one article that I read from my friend Mark, and who's really a smart guy, and I tweet him a lot. Then he had a follow-up. It was almost like he was following up to my comment, but he starts by saying, investors have a negativity bias. Events with a negative slant will have a greater psychological effect. It's important to focus on the gradual positivism that is seen in the economy and the markets. And so this word positivism kind of, I didn't like that word so much. I'm like, well, I wrote in a comment that this negative bias, it sort of keeps us alive. I think we should have a negative bias. And I'll take positivism, but only with a stop loss. So I'll be positive, but I don't want to be too positive. And I'm not even sure if I've ever heard this word positivism. And he wants me to be more positive. So I'm like, okay. I guess I can be positive. But I'm a risk manager, and my whole portfolio is based upon safety and capital preservation and longs and shorts and massive diversification and stop losses and getting in gear with the trend. So I'm not so sure I want to be known as a highly positive person, but okay, maybe if I can have a stop loss. And then later he tweets, loss aversion can harm as well as protect. Caution can be costly. It plays against the long-term positive premium of risky assets, or as we would say, the long-term positive expectation of a trend-following system. And it's most costly right after bad news, bad times. Consider the cost of caution in the same way you assess the cost of aggressive behavior. Now, I like this one a lot better because I sort of think, in my sort of worldview, what this is saying to me is, buy those breakouts. You're losing lots of money and you've had a long drawdown period and none of the breakouts are working, your recent trades, but keep buying those breakouts and understand that if you don't do that, that's way more costly than being, too cautious. And so I really like the second one a lot more. What do you think?
I mean, I think I think there's a lot in what you just said about being positive and all of those things. I think also it comes, we can certainly discuss it in the terms of risk taking, right? I mean, our industry has, in my opinion, seen a gradual deleveraging. People take less and less risk, which is partly why the returns go down, because nobody really wants to stand fully behind the strategy. I mean, and they seem surprised that returns go down as they seek less volatility in their returns. So for me, it's also about, that the fact that I think there is a cost. I think there's a real cost of being too cautious. I get your point about, having a stop loss. And of course, as trend followers, we have some iteration of stop loss one way or the other in a trend following strategy. We certainly cut our losses short and let our winners run and so on and so forth. But I think there is a point about whether we're, as an industry, are getting too cautious. And I know we've discussed this, David Drews and his views about volatility and how, we should kind of embrace it. It's not a sign of risk necessarily. So yeah, I think that it's an important point for sure. And by the way, one more point. I think a lot of it has also to do is when we all started in the industry, right? I think people have a bias towards taking more risk if they joined the industry at a certain time. For example, people who joined in 2009 and have seen equity markets go up for 11, 12 years in a row, they probably have a different perspective than certainly that I have, where I started, like 3 weeks before October 1987. And so I think that memory has stuck with me in terms of being cautious by nature when it comes to investing, which is not always a good thing.
Yeah, I agree. I mean, there's many things in there. I'm not so sure about the positivism. I know, optimism exists, and I like being an optimist rather than a pessimist. I think long term as an optimist, you'll probably have a nicer life in the upper hand. But as far as trading is concerned, like Jerry, I'd like to be very careful and cautious with my core equity, and maybe use the word objectivism here by Ayn Rand a bit more, where, the trade needs to be done in an objective way, not influenced by any prediction or by your emotions or any of that sort. You risk a certain amount of money, you let the trade develop, and then you look at the result. And the risk really doesn't change. I mean, it's kind of like a function of the system, how much risk it takes, and a function of the market's price action. So that's that. But I think what also crossed my mind when I listened to you is what I find is that it's so much easier in life to find reasons to complain about things. People, I sometimes have the feeling when I observe them, they like to complain because it's so easy to find something in your life that's not working and pick it out and then blame it on somebody else and not take responsibility and be miserable about it. I think this is so much easier for any human being to do than behave in the opposite way and reflect on what's actually very positive in your life. And there are so many things, but you kind of like discount them immediately. Let me give an example, right? You go on an airplane, each of us, we fly a lot, right? And then it's kind of like absolutely fascinating when you step back, you're sitting in a chair that flies through the air, that has been made possible by human engineering, and it allows us to go from place A to place B in almost no time at amazing speeds. But then there's people, complaining about their chair not reclining enough and the food being bad, and they have to wait a bit. So of course it's easy to complain, right? Yet you never look at the positive sides. You have a phone in your hand that works like a supercomputer that connects you with the rest of the world, and you complain about whatever it is. And I'm not sure why that crossed my mind when you, Jerry, spoke about the positivism. There was something about this. And I thought about this. It's, again, looking back on 2019 and maybe also the years prior, I have the feeling that this is coming up more and more, that, people have this tendency to become easily depressed even and complain about all those nitty-bitty things which aren't really worth complaining about. Just take responsibility for yourself. And when you look at the world you're living in, it's a fantastic place to be. It has so many positive things.
Yeah, good point.
So take this away for 2020, all the ones who complain a lot.
We'll remind you about this being positive, Moritz, if we have another one of those bond sellers we had in September.
I'll definitely complain about the bonds. It's not my fault that the bonds are selling off. It's your fault.
Yeah, absolutely. I think it's a valid point. And actually, we live in a world where we're so afraid of, other people's judgment, right? Just look at social media, how people try and portray a certain life, not to be disappointed by with fewer likes. And actually on that point, it's quite interesting. I think one of the platforms, I'm not sure, but maybe it's Instagram. I'm not an expert, but I think they're experimenting with taking away the whole issue of likes, so people don't get these highs and lows from seeing how many likes we got. Even when we talk about your tweets, Jerry, we kind of notice whether it has a lot of love or little love from the outside world. So we're all very we all pay too much attention on other people's opinion, so to speak, through these things. So
definitely. And I read something or different things irritate me. One is just over congratulations. There's just I've come across these groups that are always congratulating each other on something, some sort of piece of research or some sort of idea or some sort of tweet, and it's like 1 million likes. And I'm always looking for the unlike button, and I'm like, where is that button that I can express my dislike for something? So I much prefer that than to have a like button.
Same here. And while we're at the thing, one of the words that I really came to, on Twitter, there's so many people that have there's a random good thing happening to them and it's really not that special. And then they say, I'm blessed. And what? Why? It's like the ultimate self-congratulatory thing. I'm blessed because, I don't know, my soccer team won or something like that. It's ridiculous. Everybody seems to be blessed these days.
Absolutely. We'll all be very careful about using that word going forward, Moritz.
Yes. Well, you should be.
Yeah, I know.
Good stuff. All right. What else happened on Twitter? I think this is a fun conversation today. All sorts that is not in our usual script.
There are a few articles around, I would just say. I know I read one recently. I didn't tweet it, but Morgan Housel. And I've seen other articles recently at the end of the year, that, I don't really take these that seriously because I think people, I don't know if they really believe this or if their heart's really in it, or it's just, hey, everyone's written the opposite of this, so I'm going to really write this just because it's the opposite. So, but one of the things I've read was that people are sort of creating lists and acknowledging that we live in pretty darn good times and trying to take notice of the fact of all the things that have gotten a lot better, in life in general. So that's kind of nice to see. I think they're probably sincere about it, but it's hard to say because if you read a lot of negative stuff, then, write something on the opposite of that, and I guess you'll get a lot of people reading it. But the world is a pretty good place these days as far as improving over time. We're getting a little bit better and nicer, I guess, in some regards. Maybe not nicer. I shouldn't have thrown that in. Not in the U.S. anyways. We're not that nice these days.
Good stuff. Well, yeah, I know we kind of challenged each other of picking kind of one topic a week, maybe going forward, that we want to talk about, and who knows if we can do that. But maybe one of us or two of us or all three sometimes will have something. And for me this week, there's one thing that we already touched a little bit on. It's to do with the amount of information we're getting, and I stumbled across some information about a guy called Buckminster Fuller, which I had never heard about, who lived from 1895 to 1983. And his career didn't start so, positively, because he got thrown out of university for being too social and for missing some midterm exams. But actually, it ended pretty well, because in 1983, I think just before he died, he was awarded the Medal of Freedom, which I think is the U.S. highest civil honor that you can get. So clearly a man who contributed something of much value during his life. And one of the things that he worked on was, and where he made some, I wouldn't use the word prediction, but he made some statements about the amount of information we as a total human race, how long time it takes for all of us to kind of double the total knowledge we have in among humans. And he estimated originally that in 1900, the year 1900, so 120 years ago, it would take 250 years for that amount of knowledge to double. But then later on, he realized that actually by 1900, we were down to just 100 years, a century, before the whole total knowledge among humans had doubled. By 1945, he said that it was now doubling at every 25 years. And by 1982, it was doubling every 12 to 13 months. And then IBM got involved, and they made an estimate that by 2020, which is now, human knowledge will be doubling every 12 hours. And to me, that's just a staggering fact. But I also think it has huge consequences, not least in terms of, investing and investors in general. Because, I mean, and let's move away from what we do, but people in general, a lot of people who make investment decisions are basing it at some level of knowledge that they feel they have. They study a set of accounts, they study macroeconomic data, whatever it might be. And then they feel that they know enough to make a decision. But if information among humans are being now doubled every 12 hours, to me, that just means that whatever worked 40, 50 years ago in terms of doing this kind of analysis and feeling that you now know what you need to know, I just think it's completely impossible nowadays with the amount of information that is being available to humans. So it reminded me actually of this old saying that I think Larry Hite coined, knowing what you don't know. I mean, to me, that philosophy is probably more relevant today than it's ever been. And getting away and not relying on prediction and educated guesses about earnings and future monetary policy, which of course we saw in the last decade, can be very different to anything we could ever imagine. So embracing these rules-based strategies to overcome our fragile biases and blending them with traditional portfolios, where all the evidence, and I'll definitely repeat that, I mean, all the evidence suggests that you can achieve higher returns and lower risk if you blend these things together. So I think it's, incredibly interesting that we are now at a time where we are literally being bombarded, or humans as such are acquiring so much knowledge at a huge pace, and that this will, I think it will have an effect on success of maybe old style type investment strategies. And maybe that's why, frankly, that quant-based strategies have seemed to taken over in terms of being the most reliable and best performing strategies when you look at the league tables, at least, of hedge funds. Did you know about this?
I didn't know about that. I'm amazed that knowledge can double every 12 hours. I'm not sure how that can be possible. Maybe what he means is the amount of information available, data that's stored and data that's made available through smartphones, and because you're tracked on your data.
No, I think it means that. I think it means if you look at all humans, in total.
Yeah.
So all humans we're all amazing more information, but of course a lot of people who had very little information 10 years ago or 20 years or 50 years ago who probably didn't learn anything new in a whole week. Now they're learning new things because of, as you say, because of some of the technology we have, of course.
We're becoming more intelligent as a group.
I don't know about intelligent, but we have more knowledge. I mean, intelligence suggests to me that we're making better decisions, so I'm not sure that's the case, but we have more knowledge. We know more. That's, I think, what the study or what IBM is saying.
And every 12 hours, we know twice as much as we used to know 12 hours before.
That's what they say as a combined human race, yeah.
I find that almost impossible to believe, but let's just say it's true. I give you the benefit of the doubt. Like I said, I haven't read anything about this. I guess what I'd say is that I can only speak for myself, but there is so much information available that you only have 24 hours in a day. It's impossible to consume it all. In years prior, say 20, 25 years ago, when the internet was only just starting, you weren't bombarded as much with information or a real-time Twitter feed or any of that, or breaking news and this and that all the time, right? Everything's available for you to click on and read, or have a video streamed, or look on TV. So there's so much, you're bombarded with that stuff that it's overwhelming. And I think, just speaking for me, it's probably a good idea to step back a little from that massive flow of information and not try to immerse yourself too much into it, because it can really take you over, and then you don't have really any time left to do meaningful things, or more meaningful things. So that's something that I've observed. It's a fact. The information is available more and more at a faster pace, and to me, it is too much. I'd like to have a filter where really only once a day or twice a day I can see the most important things, and then no longer read all the other stuff.
Yeah, when I hear things like that, I immediately say, not true. Move on. You've lost me. I'll never believe it. But sometimes it can be true, and so I miss out. But yeah, that's the sort of thing that I'm like, no, sorry, I can't believe that. I'm not going to even finish reading this. But I think it's interesting that the trend follow, even if it's not true, and we don't, we still have the same amount of information. We're still going to follow prices only, right? And so, if in fact information, as we know, it is getting more and more, and I don't know if it's helpful either, but then that further makes us committed to only looking at prices. The world is too complex. There's too much information. And so the trend followers are saying, okay, it'll all be filtered into price somehow, and I'll just be double my commitment to just looking at prices. And yet now the big rage is artificial intelligence and machine learning, and they're like, oh, give me more. Yeah, I want more data. And this will help me with my algos, massively complex algos that will soon be written by algos. The new algos will be written by the old algos. This is going to help me make better decisions. And so I think it's really interesting that the two different worldviews here is one's being embraced by the new side, and we're sort of sticking to our guns with more of a reason than ever to just follow price.
Yeah, absolutely. I don't know if you have any other topics you want to bring up this week before we jump into some questions we have.
Let's do the questions.
All right. So first question of the year 2020 is from our good friend Sam. Sam talks, I think the topic of the email, I'm not going to read all of it, is about diversification. Sam goes on to say, a lot of the global diversified content, think Faber and his guests, will talk about a portfolio of U.S. international equities and bonds, including developed and emerging gold, real estate, tips, and commodities. A fine start, better than the majority, and something I agree with. When trend following is discussed, and in looking at markets like done trades, for example, it seems much of the equity and bond exposure is in developed markets. Do you think there is an opportunity to further diversify portfolios into additional asset classes such as emerging? Is the portfolio composition a function of available liquid futures markets? Does it really not offer further diversification to expand, etc.? The only emerging market type exposure usually discussed is within the currencies and these regions/countries. So, portfolio construction, further diversification opportunities by going outside, maybe the developed markets. What are your thoughts to Sam's question?
Well, I'm happy to start with that if you don't mind. I think we've said many times that we're all big fans of maximizing our diversification, and if there are new markets available for us to trade, then we definitely want to give them a very close look. Now, as far as the equities are concerned, I think there are markets available for a trend following system to become really diversified and trade markets all around the world. Even some of the emerging markets. For instance, there's an emerging markets, MSCI emerging markets future that trades in a very liquid way, which could be used, but also you can, trade the Nifty, you can trade Singapore, you can trade South Africa, you can trade the cash equities there if you have the right broker. So as far as the equities are concerned, the world is your oyster and you can really go and access those markets. The bonds, that's a different thing, right? First off, I'm not trading any corporate bonds, right? So what I'm trading is government bonds. Corporate bonds is, again, one could actually think about adding corporate bonds to a trend following portfolio. It's just for us, there are no futures markets linked to those type of instruments. So you would have to trade the cash markets. That's an OTC marketplace. There's no exchange where you can find a bid and offer and just easily click you in and out of a position. But going back to the government bonds, it is really more limited what is available. The developed markets, they have government bond markets, but then, I'd love to trade South African bonds or Thailand bonds or Vietnam bonds, but they don't have any. There's nothing issued. Or maybe if it is issued and they have a treasury that, funds itself through the issuance of bonds, there's no futures market available that I can trade. And I'm unable to access any of the cash bonds. So those markets aren't that easily available. And therefore, in the bonds, it is more limited to really, or it's more difficult, not limited, it's more difficult to really maximize your diversification as much. Because the developed bond markets, they're also positively correlated. Like yesterday is a good example, right? It's been a risk-off day. US bonds up, Canadian bonds up, Australian bonds up, German bonds up, all the bonds are up. There's probably not a single bond market that has been going down yesterday. So there we are.
Yeah, what about you, Jerry?
Well, yeah, I understand all of that, but I think that our bent needs to be towards, yes, I'm going to trade it. If there's liquidity, whether it's a futures or not, I trade a corporate bond ETF. So there you have it. I will venture over into sort of an index-like approach, let's say, by using this corporate bond ETF, an emerging market bonds ETF. You can trade those, so it's not a pure play on each individual country or company. But I think they look a little bit different, and they were, I think one of those was down yesterday. So there's a little bit of diversification to be gotten. But I think our mistake that CTAs have made for many, many years, myself included, is not venturing out beyond futures and trying your best to find markets that are different and not the same markets that everyone else is trading, whether it's single equities or bonds or, just always be on the lookout for ways to add to your portfolio. But, liquidity is the issue. So if you can say to yourself, I trade everything I'm able to, I've done everything I possibly can to trade every liquid market. Yeah, that's the attitude I think you want to have for yourself and your clients.
Yeah. And Sam, I don't think I can add much to this. All I will say is that we trade probably a lot less markets than both Jerry and Moritz do, and for various reasons. I think definitely, as Jerry says, liquidity is super important, and we wouldn't venture into anything that's not liquid. The other thing I will say is that I do think there is a limit to, I mean, and we know that the marginal benefit of diversification, once you get to, 60, 70, 80 markets, I mean, of course, it does drop down if you want to stay within the future space. But as Jerry says, I mean, there are other ways you can expand your universe of markets so, but it's a good point. But I also do think that some of the larger CTAs for sure have ventured into some of these more alternative markets, including emerging markets, and they've had great success with it, without a doubt. So there's probably been some trends to be had more consistently by going out to less liquid markets. So yeah. The next question is we're going to stay in the US. We're going to move on to Houston. We're going to move on to Edmund. So Edmund says in his email, I love the podcast, guys. It brings me back to where I started with trading, had initial success, kind of wandered off from, and where I want to get back to. Along the lines, do you have any thoughts on good backtesting platforms that will handle portfolios with multiple trend following strategies and allows for customization of position sizing? I'm an individual trader, don't code, at least not yet, and the platforms I've been looking at seem mostly geared towards optimization of signals and fancy indicators with a few canned position sizing options thrown in. I'm more interested in a program that provides very detailed stats on backtesting, can let me explore the envelope on position sizing regimes. Anything off the shelves come to mind, or am I looking for something that requires custom coding? Let me throw it out to you again, Moritz, if there's anything that springs to mind on your side.
Yeah, unfortunately, I'm unable to give any good recommendations. I'm not using any of those platforms. I'm sure there are some available, but I'm the wrong person to really give recommendations there. What I've always used and still use to the present day for prototyping is Excel. I think it's fantastic. It's become more and more powerful over the years, and then custom coding, and that can be in Python or in C# or whatever the language of your preference is, to set your system up. That's the way it works for me.
Yeah, I love Excel. TradeStation probably is still something that might work. Yeah. So, but probably what I recommend Excel. Play around with Excel. If you're not a programmer, then come up with your ideas by looking at charts in Excel and hire a professional programmer who can do the back test. And I like to think I'm being more creative and problem solving, and I'll leave the coding to an expert.
Yeah. And maybe I'll give a shout out to one of the people who attended our live event in New York last year, Seth, who does some videos on YouTube with Sam, I believe, and maybe that's a topic for you and Seth and Sam to do a video about backtesting platforms. I know you used blocks. I'm not endorsing it. I don't know it, but you seem to be happy with it, and you said it was easy to use. So maybe, Edmund, that's something for you to have a look at. Next question we have is from Drew. Drew starts, howdy guys. I believe each of you would agree that your models have been adjusted somewhat over time, such as longer lookbacks, etc. What evidence did you see that made you realize something needed to change? What deviation to past performance was most influential? What made you believe the system wasn't having an outlier type performance versus a new norm requiring change? Going forward, what are you watching for to know if you need to make adjustments to your model, or are you even concerned with that? If you made adjustments once, there's a risk you'll need to do it again. Interesting question, Drew. What about you, Moritz? What have caused you to make changes from time to time?
Yeah, that is a very good question, and there is not a single answer, but it is performance and risk-adjusted returns and drawdowns and the statistics of my risk and all of that, which probably made me go longer term. I mean, the basic and well-known shorter term breakout models, which I started backtesting and using, they stopped working as well. I'm not saying that they are completely defunct. They just don't work as well as they used to. And then if you compare that profile to the longer term, first the medium, then the longer term trend following models, you didn't see that same level of degradation in returns. So there was more stability there. And I guess this is why I've, swayed over.
I mean, I think looking at charts and living through trades where I was just continuing to get out of the trade and watch it go back to new highs and continue making money, sort of got me thinking maybe my trailing stops are a little too close to the market. So then when you do the back test, you get that confirmed or not confirmed. But I would say that just to pick on one little point that he made was that it's whether you make these changes or don't make changes, you're still going to be having an idea in your head that maybe I should make some changes. So making changes doesn't mean you're going to have to make more changes. You may make more changes having never made a change before. So, I don't think that this is this system is this fragile being that exists. And if you touch it and you change it, now you have a lifetime of changes ahead of you. I mean, I don't approach it in that way. I think, and once again, as I said many times, the great thing about changing and the way that I've done it is that when I've made changes, the changes that I have made have worked over the entire data set. It's not like I said, I think I'm having an issue here. Let me test it over the past 30 or 40 years. Oh, it works great over the last 5 or 10 years. No, it worked better over the entire test period. I should have always been trading longer term. Even in 1984, trading longer term like I do now, I think worked better than what I was doing then. So I think that's another key is you don't want to just, unless you have to, you prefer to make these changes and have the data all of the data confirm your change.
Yeah, no, I think all of those are very important points, Drew, to take away. I mean, on our side, so over 45 years of trading, we've made maybe 3 to 4 bigger changes, and I would say 2 of them bigger than the others. So it's not like you have to make changes all the time. You'll make small adjustments along the way, without a doubt, adding markets, removing markets, things like that, and so on and so forth. One of the things that we changed, that's 14 years ago, was the idea of having automatic selection of parameters, right? So that's something that, once you've made that change, it's probably quite unlikely we're gonna, go back from that. So I think when you decide to make a change, you've done all your research, you're convinced that this is a better way of doing it. Like Jerry says, I mean, it has to be better throughout, not just to fix a short-term problem. Then I mean, it's obviously every time you make a change, there's a chance that you're going to get it wrong. But I think we do our best to make informed decisions, but try not to make too many radical changes. Also, keep in mind that our clients, they do want us to evolve as managers, but they don't want us to change our profile. So that's a balance we have to take into account as well. But of course, trying to make things better, I think, should always be, small incremental improvements, I think, should always be something you strive for, of course.
Yeah, I mean, I think especially if you can, apart from the research and the back test, think about how you do things and say, oh my gracious, I think I'm doing something wrong here. And that's, I think, a very big positive. I know that over the years, especially after 2008, it was almost like every little flaw we had never hurt our performance before. We'd never really seen it except when 2008 rolled around. Well, maybe not 8, but maybe 07 or 09. There was a stressful period around there where it's just like everything we kind of did wrong. And I remember thinking these were not things we necessarily uncovered by research. It was just like we were thinking about them and we're like, oh yeah, we shouldn't do that. And it didn't even show up in all of the data until all at once. Every kind of little minor problem we had. And I think approaching it from rather than data mining, I think looking at how you do things and say, is that kind of the way you should do it? As it relates especially to, I guess I'm mostly talking about money management and sizing and things like that. I think we just sort of said, I don't think we should be doing things that way. And I think coming up with those ideas in that way is probably more solid than sort of data mining, I guess.
And also, I guess technology in itself, just the advancement of technology has allowed us to do things in that we couldn't do 10 or 15, 20 years ago, essentially. I know that for a fact. I mean, for us, doing what we do in terms of automatic selection of parameters, I mean, that requires quite a lot of computer power, and we couldn't do that 20 years ago, but we could do it 14 years ago. So that's when we made the change. So good stuff. Great question, Drew. Thanks so much. And by the way, if any of you want to hit us up with a question, we would love to hear from you. If you email info@toptradersunplugged.com, then we'll do our best to bring up your question on the next recording we do. Right, so the last question is from Sebastian. Sebastian writes, I wish you Happy New Year. Thanks very much, Sebastian. I recently asked myself the question, why is it so hard to be a successful trend follower? Because if you look at non-finance fields, it seems to me that people are great trend followers. For example, in the fashion business, so many people jump on a new trend and ride it until it's over and the next trend starts. They don't see the invested money, for example, in clothes as a loss, because to be in that trend gives them a good feeling. Why most people can't ride these trends? Why can't most people ride these trends in financial markets? And then he goes off by saying, maybe a bit of an unusual question, but I'd like to hear your thoughts. And I think it's a great question, Sebastian. It's good to venture outside our sort of typical narrow bounds. And I think that just to jump in on this, I mean, I think, Sebastian, you're right that in many ways, humans, we are trend followers deep down. I mean, we follow trends in fashion. We follow trends in social media. I mean, we have some wiring for that for sure. But we also have some wiring inside us that makes us poor investors. We want to take action all the time. We hate being patient and things like that. And then it goes against some of the key points within trend following. So I think there are some forces that collide inside us when it comes to being a disciplined, long-term, diversified trend follower when it comes to your investments, and then how we are as humans. But when it comes to kind of following other trends, as in clothes or fashion, you're absolutely right. Most people do that with ease. So what do you think, Jerry and Moritz, about this point?
Well, as I've said before, I mean, I just think as a human, I have this initial reaction almost all the time of, no, that's not going to work. And I think you need to have the opposite reaction and say, it's mentally or actually my trading, okay, whatever, it's a new high, I'll buy it, and I have a stop loss. And that needs to be your attitude in life, that, it could work. It could become an outlier. The internet might work. The iPhone might work. Netflix, I could see how it could work. And so just be the type of person that put yourself in a situation where you're going to react more positively towards crazy ideas. Most of them won't work, and so you have your small loss. But I just felt like historically I've been so negative about something new, is that my attitude is, it's sort of insulting. I didn't come up with it. It's sort of insulting my intelligence. Probably not going to work. I think it's much better to think about things in a positive way.
What about you? Are you secretly trending a fashion trend follower as well?
I'm not so sure about that. You need to tell me. You look at me and the way I dress, but
we'll ask your wife about that, Moritz. Really,
you can do that too. And she'd probably say that I need to buy some new clothes. But anyway, I think if you walked around today in 1930s fashion or like the 1970s, 60s, 70s flower power type of dresses, then people would be looking at you in an awkward way. So being like going with the fashion is probably good for you because people don't look at you in an awkward way, and maybe they congratulate you on the latest sweater that you've purchased because it looks nice. So that's kind of like an easy thing that you want to do. In the financial markets with our trends, look, I mean, this is more difficult because most of them cost money. You're kind of like being told more often than not that what you're doing there is a bad trade. You're losing money, and you have to wait for those large winners, and that can be a long wait, and it can be very difficult to sit through it. So it's more difficult to do it in the markets than in the fashion industry.
All I can say, Mort, is that having two teenage kids, following the latest fashion in clothes is also something that costs real money, not just trading.
Sure.
But what I will also add to that, again, another little something I picked up, and I have no way of verifying this, but apparently the fashion industry a couple of years ago started, putting out things like more yellow type clothes and more camouflage type clothes, more combative clothes, etc., etc. And the person talking about this made the connection, saying that it's quite interesting that often the fashion world is ahead of time to what happens in the real world. And of course, she was tying this into the yellow vest movement in Paris, where now we see all this coming out in the streets of Paris. But actually, if you looked in the fashion houses a couple of years ago, it was already starting. They were already starting to put out things that, was a little bit, if not a lot, in the direction of what you see now in the streets of Paris, but with a completely different meaning. So maybe there is a bit of more of a link between these things, Sebastian, and maybe your question is not so unusual as you put it. It's interesting for sure.
I think to a large degree, I've read articles over the years that movies and fashion and people in business, they have a very similar process and experience that trend traders have. They take these flyers, especially in movies, and they have no idea if it's going to work or not. They're just as surprised as anyone else that this particular movie was a huge smash, and they make all their money by a few of these outliers, and they can't predict which ones are going to be outliers. And I guess that's what I'm kind of saying is that, take a flyer, just take a small one, build a diverse portfolio in all areas of your life. Something looks crazy, you can't even identify with it because it's, teenagers or younger people who really will probably push it or not push it. And then all of a sudden it explodes into something amazing. And, you look like a genius. And I think this formula of life that we sort of have with our trading is around in all aspects of life.
Yeah.
Yes.
There we are. Let me jump in. Thanks for all the questions, by the way, to Sam, Edmund, Drew, and Sebastian. Let me just quickly round off 2019 because, of course, when you last heard from us, the year hadn't finished. But let me just run through how the year did finish, in fact, for the various indices that we track. The Beta 50 index ended December down 32 basis points, but ended up 6.73% for the year. The SocGen CTA index was down 53 basis points in December and up 6.36% for 2019. SocGen Trend Index down 0.5% in December, up 9.28 for the year. And the SocGen Short-Term Traders Index was down 7 basis points in December and up 3.33 for the year. And finally, the Bridge Alternatives Index got hit in December, down 2.11% and up 7.29% for the year. So not a bad year. And since we only have 1 or 2 trading days, and actually only one that I can track for this week, I'm not going to spend time running through, what the indices have done on Thursday, except to say that they were all up a little bit. So there we are. What else should we talk about, if anything, before we wrap up this week's conversation? Anything that springs to mind? Any topics? Anything you are excited about, other than the three of us actually meeting up physically in a couple of weeks in Miami? That's exciting, at least to me. Watching some basketball, I'm told. That's exciting as well. So January looks already very, very good.
Special guest next week.
Oh yes, of course we have a special guest, Andreas Clenow, a very popular guest, I think, among our audience, the author of Following the Trend, his first book, which we will try and dig a little bit deeper in. I think in particular you, Jerry, have lined up a number of topics you want to discuss, and we'll certainly think of a few as well. So that's exciting. If you do have questions for Andreas Clenow, I think some of you might, then send them to info@toptradersunplugged.com, and we'll do our best to get as much time as possible with Andreas so that we can go through as many of your questions, if not all of them. Anything else, gentlemen?
No, it's been fun. Looking forward to meeting you again at the end of the month and hanging out, catching up, and looking forward to speaking with Andreas next Sunday.
Absolutely. Yeah, cool. Well, that's it for this week. We hope you enjoyed our conversation. If you did, of course, we would be delighted if you would help others discover the show by leaving a rating and review on iTunes. And please share this episode with a like-minded friend. One share is all that we ask for. From Jerry, Moritz, and me, thanks so much again for spending part of your day with us. We're grateful for your support, and we can't wait to be back with you in a week's time. In the meantime, have a wonderful week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the